Hello everyone, welcome back. I got some really good ones for you today on this Saturday, April 5th, 2025. A lot's been going on with the markets and the economy. That's what we're going to be focusing on for this video. So welcome back. Glad you made it. Glad we can hang out together. And let's dive right into this dumpster fire, shall we? So headwinds, problems, fear, uncertainty, and doubt everywhere. Oh my gosh, what's going on with these markets and the economy, you guys? Pretty crazy stuff, since my last video. So let's build a framework. Let's discuss where we've been, where we are, where we're going, and hope for the best. Really, geez. I would think the Fed and the Treasury, the commercial banks right now are holding an emergency meeting. They need to, like yesterday. So if they're not holding one today, I think they'd be holding one tomorrow. Hopefully, it doesn't look like Powell's really working well and cohesively with Trump right now. It looks like they're having a bit of a problems between each other and between their institutions. We have the Trump admin and the Federal Reserve System. They seem to be at odds. It's not good, you guys. Normally when the market starts coughing up 5-6% per day, you see an emergency meeting. You see a unified front to contain the problems, prop up the beast system, bring certainty to the 401k pension Ponzi beast system. We just don't see that right now. Could be wrong. Maybe they're holding the meeting right now. They don't want to hold a meeting, I guess, so we're going to, and we're just going to hope for the best kind of thing. So no emergency meeting, dang, because these fires are spreading, you guys. Even just in the last 24 hours, things have gotten completely out of control. So let's rewind the clock back to January. Trump inherited a bit of a bubbly market, I would say. The NASDAQ went up about 40% in 2024. It should only be going up like 15% a good year, so like 3x what it should normally be doing. Bitcoin was over 100,000, house prices pretty much unobtainium. Markets were just really frothy and bubbly when Trump took over in January. In January, we also saw the inverted yield curve between the 2 and the 10 become uninverted. And historically, when the yield curve inverts, you wait for it to uninvert, and then you count forward 6 to 18 months, and 11 out of 10 times you get a recession. And what I mean by that is sometimes you get a false alarm, sometimes you get a yield curve inversion, but no recession. But you can't have a recession without an inverted yield curve. Well, in January, we had an inverted yield curve. It uninverted, count forward 6 to 18 months. That's when you're supposed to get your recession. Looks like Christmas is coming early. It looks like we're getting this recession a little bit early, So yield curve as a leading indicator for recession, not looking good. Other leading indicators like the leading economic index declined 0.3% in February, now down 1% over the past 6 months, indicating weakening economic momentum. So the LEI as a leading indicator of recession, not looking good. Credit spreads as a leading indication of recession, not looking good. We have credit spreads at levels seen few times in history. Last being May of 2007, and we all know what came after that. So guys, credit spreads aren't looking good. Consumer confidence continues to fall. We've had 4 months now of decline in consumer confidence, reflecting growing consumer pessimism. ISM manufacturing PMI slipped below 50 back in March, so now we're at 49. That means contraction. So manufacturing PMI pointing towards a recession, consumer confidence pointing towards a recession, credit spreads, LEI, inverted yield curve, like pretty freaky stuff, you guys. Then you got these tariffs, right? Which we're going to spend a minute on these tariffs. The tariffs have injected a lot of uncertainty into markets. Really what I see has happened is in January, Trump took over a already pretty frothy, overinflated market. Then he injected a bunch of uncertainty into it at a time when leading indicators were already pointing towards a recession. And now it just looks like the bottom's completely falling out, especially as some of these other countries like retaliate with tariffs, which the market can't really price in until it's happened. That's one of the problems with tariffs. Guys, generally, I don't like tariffs, so that's a good starting place for me with tariffs. I don't like them. People will say, oh, it's just a tool. It depends on how you use it. Maybe. If I were to agree with that, I'd say, okay, well, you need to be like extremely careful how you use that tool. And Trump seems to be pretty unwieldy with this tool. And whenever he runs into problems, he just doubles down with it. Pretty wild, you guys. It's like, problem with trade wars is you shoot your own team, okay? So what I mean by that is when Trump slaps China, who's been, quote unquote, ripping us off with tariffs, all he's doing is saying, hey, these guys are ripping us off, and then turning around and mowing down his own team because we're the ones paying the import tax. Trump called it Liberation Day the other day. How about tax hike day? How about Republican tax hike day? Does that have the same ring to it? Because that's essentially what it is. All those increases in price from these tariffs just get passed off onto the U.S. consumer. So again, it's one of those things where Trump convinces you that all these other, and he's right, okay, to some extent, that all these other countries are ripping us off. But then he loads the clip, turns around, and starts mowing down his own team. And that's kind of how trade wars work. If you want to win a trade war, in my opinion, you don't fight one. I don't think it's a good idea for countries to decide who their citizens should be sitting next to at the lunch table and doing business with. So we're in a situation now where Trump and his admin are pulling levers and pressing buttons and trying to micromanage things. And really, he should be slapping products with tariffs if he were going to do this, but he's slapping countries with tariffs. It's kind of weird. So I don't know. I don't like tariffs to begin with, and then Trump executes them in a way that really freaks the market out. And then when other countries retaliate against these tariffs, Trump just doubles, triples down even. So created a lot of uncertainty. I generally don't like tariffs. What I'd like to see is Trump roll back some of these tariffs over the weekend, because if the Fed doesn't hold an emergency meeting with Trump, if the Treasury and the commercials aren't in the room for this meeting, if Trump doesn't roll back tariffs over the weekend, guys, Monday could get ridiculous. Jim Cramer's already predicting this. Now, I will say, on this channel, we generally go inverse Cramer. We like to bet complete opposite him, but he might be right this time, So Jim Cramer saying Monday could get pretty gnarly, and I tend to agree with him, because if we're not containing the problem, then look out below for Monday. Look to what you have been experiencing to continue until they have these problems contained. Another problem with these tariffs is, in theory, it makes sense what Trump is doing. Okay, so I'll give the man credit where credit is due. In theory, if you punish all these companies outside the United States for trying to access this market, that incentivizes them to bring their manufacturing base back to America so that they can circumvent and not have to pay the tariffs. In theory, pretty good idea, and I do believe we need to repatriate our manufacturing. So I'm with bringing factories back to the United States and building up our middle class on something other than a services economy. I'm totally with that. Problem with it is the roadmap for that is 3 to 10 years. The build out phase for that 2 to 3 years, and then really to get things going, to really start bringing companies back to the United States for manufacturing, that's a 10-15 year roadmap overall. So when Trump's going on TV and telling you it's a little bit of short-term pain, probably 2 years for midterm, long-term gain, I'm not really so sure about that. And even in the best case scenario, if it only takes 2-3 years to repatriate our manufacturing, well, what's going to happen to markets between now and then, And the stock market today is trying to price in where it thinks it should be in 18 months from now. So the markets are looking out 18 months from now going, I don't see any relief in sight. I see a lot of pain and a little bit more pain after that, and a high probability of a little bit more pain after that before really we get things back on an even keel, bring the manufacturing back, and make America great again, as it were. So Trump's plan to save our manufacturing and save our country, it's a noble cause, in my opinion, but realistically, it looks a lot more painful than he would have you believe. And it's inflicting a lot of damage on his own people, which he's going to downplay that. He doesn't want to call Liberation Day Republican tax hike day, and that's really what it is. It's an import tax. That's what these tariffs are. You're just taxing the Americans harder at a time when inflation's already really bad. I mean, used and new cars were already kind of unobtainium even in January. Now look what these tariffs are going to do to the auto market. We could be looking at $5,000 to $15,000 price increases for cars in the United States, especially the BMW and Mercedes, those foreign car companies. Dude, those tariffs are going to drive those prices up here insanely. And you could be okay, well, what about domestic car manufacturers? Are they okay? It's kinda. A lot of their parts are created outside the country though, and they're gonna have to pay tariffs too. So you see, there's nowhere to hide in the automobile sector, and that's just one sector, the economy. And Trump's gone ape shit with these tariffs. So pretty freaky stuff with the tariffs, and I'm hoping Trump rolls some of this back like yesterday, like over the weekend, like tomorrow, before Monday, before Monday hits. So the tariffs have created a lot of uncertainty for these markets. We also have interest on the debt now exceeding annual defense spending. That's generally like a really bad red flag. The empire of Spain went through that. The British Empire went through that. And now the American Empire has had its first year of interest on the debt being higher than defense spending. Go ahead and plug into ChatGPT. What happens when interest on national debt exceeds defense spending? Like, what's the historical precedent for that? What happens whenever empires are faced with that situation? What historically comes after? And you're not gonna, it's dark, guys. It goes to a pretty dark place. So I don't like these interest rates so high that our interest expense is like trillions of dollars a year. That basically we got to come up with trillions of dollars a year just to meet our minimum interest payments on our country's credit card. That's one way to look at it. And these tariffs, the idea of these tariffs are to help with that. Implement the tariffs, collect the money from that tax revenue, and then you can funnel it into your $2 trillion deficit and try to soften the blow there. And that's kind of what Trump's trying to do too. Trump also is putting a lot of pressure on Powell to cut interest rates because we don't want to be in a situation where our interest on the debt is exceeding the budget for all these other things like defense. So Trump wants to get interest on our debt down. If we're a country that's 37 trillion in debt, do you want to be paying 5% interest on that, which is like a couple trillion a year? Do you want to be paying like zero on that, which is nothing? He'd prefer zero. So he really wants to get the debt negotiated at a lower interest rate. Problem with doing that, though, is when you cut interest rates, you just weaken the dollar more. So all these inflation problems we've been dealing with for the last half decade it's just going to stoke more inflation if we start cutting interest rates right now. I mean, if you already have an inflation problem, which we do, and then you start cutting rates, you're just making that worse. So we're a bit of between a rock and a hard place. On the one hand, we want to cut interest rates so that we don't need to come up with trillions of dollars to make our minimum interest payments. But on the other side of that, if you cut interest rates, you're weakening the dollar, making inflation work. So it's worse. So it's really hard to like thread that needle and walk that tightrope, something that Trump's been trying to do, and something that Trump and Powell are at odds about, which is another problem. Like, Trump and Powell aren't working together. Trump and the Fed aren't working together. Trump needs to get the Fed, the Treasury, the commercial banks into a room like right now, and they're actually mad at each other right now. Powell spoke at the Society for Advancing Business Editing and Writing Conference in Arlington yesterday, gave us a little presser and Q&A. I listened to it, guys. It was horrible. So where Powell should have been blowing a bunch of smoke up the market's butt and trying to bring a little bit of relief to these markets, he came out with keywords like highly uncertain, diminishing expectations, tension, inflationary pressure, painful, tight, progress has slowed, near-term inflation expectations have moved up, elevated risk. Like, the markets, the algorithms are all reading what Powell's saying in real time, and they weren't liking it either. So it's almost like Powell tried to stop Trump from making a big mess. Trump didn't listen to him. Marcus starts to vomit all over the place, and then Powell just comes out and he's pretty much like dropped his binder, dropped his pack. He's mad at Trump, so now he's not doing anything to support markets either. So it's like all these institutions that are supposed to be supporting the beast system, the pensions, the Ponzi's, the 401ks, they're all just like in their respective corners refusing to come together, and like that's freaky, Over this weekend, really over the last 24 hours, we're looking at now, I'd say 4 interest rate cuts, 3 to 4 interest rate cuts, you guys. I'd say 2-3 weeks ago, we were looking at 2 interest rate cuts for this year, both at the back half of the year. But now that the bottom's fallen out for markets, it's looking like instead of 2 interest rate cuts, we're going to get 4. Silver lining there is as soon as the market sniffs out 4 interest rate cuts instead of 2, should begin to inflate. So, crypto should start moving back up. Energy, gold, I'd say gold, but gold's doing quite well. Tech stocks should start to recover as soon as the market starts to sniff out 4 interest rate cuts instead of 2 for this year. So that's a little bit of a silver lining. The rate cuts are going to come and bail us out, right? And then another silver lining would be your unemployment is still pretty low. Unemployment right now is only 4.1% if you believe the jobs number, the jobs data, which I take with a massive grain of salt, but take it at face value. Unemployment pretty low right now, which is a good thing. Problem with that, though, is unemployment is not a leading indicator like these other leading indicators we discussed earlier. Unemployment is a lagging indicator. So the way it works is stock market crashes, then everyone gets laid off. It's not everyone gets laid off when the stock market crashes. So now that it looks like the stock market might be cracking and potentially crashing, unemployment could begin to spike, that now you lose your job kind of thing. I don't think they can let that happen, though. So whenever you're 20% off of recent highs in the major stock indices, which I'd say we are, like with the NASDAQ in a bear market, Russell 2000 in a bear market, S&P 500 about to be in one, Dow Jones about to be in one. Fed's got to move, Trump's got to move, Treasury's got to move on this. Because if we go negative 30% off all-time recent highs, negative 25, negative 30%, well, then the odds that we end up going negative 50% off recent highs and a massive mean reversion for markets, like that starts to skyrocket. Like basically, guys, once you've corrected 30%, the odds that you end up correcting 50% begin to skyrocket. So they really have to contain things around the 20% line, 25% line, and the Russell's already there. So they need to throw the beast system a $2 trillion stimulus or some sort of juicy steak to get things moving the other direction, which I think could happen, you guys. I think if institutions can come together, maybe we see a V-shaped recovery like we saw for the COVID shutdowns, just a V-shape, like you're in recession and the next day, once it's apparent that you're in a recession, it's pretty much over. We're already climbing our way out of it. It could be like that. I think there's a higher probability of that than most people think, and that's just because historically that is what tends to happen, guys. Like dips don't last long in these markets. Have you noticed that? You might get a 20% correction in the three major stock indices, but 80% of the time we hold the line at 20% and then we down 20% and then we reinflate from there. It's 10-20% chance that you trade down 20% and then you end up down 40% like right after that, especially if institutions move on this and contain the problem. So we need interest rate cuts. We need certainty injected back into these markets. We need institutions to be working together, not at odds with each other. We need Trump to roll back some of these tariffs. That's our pathway forward. Or Powell keeps, arguing with Trump. Trump keeps spending his time on the golf course. And markets left to their own devices don't really know what to do because we're looking at 10 years of pain with these tariffs before things are good again. The market just has nowhere to go but lower, so what I'm doing, because I'm not giving you financial advice, guys. I'm not a licensed fiduciary. I'm not a financial advisor. I'm just a lowly retail trader like you. What I'm doing, though, is just sit tight, stay right. I still like energy. I still like high growth tech. I still love precious metals, physical kind. Stackers, keep doing your thing. Stackers never lose. We can hang with gold for a minute. So gold recently hit a new all-time high. It hit 3,200 per ounce. Pretty awesome. It's since pulled back to about 3,000. When I did my gold and silver 101 video for you guys a couple years ago, gold was only 1,700, so we've effectively doubled in the gold price. But gold didn't become more valuable, guys. The dollar just got cut in half. The gold supply inflates at 1% a year. Civilization in real terms grows at about 1% per year. The gold dollar is very stable. An ounce of gold got you a nice suit in 1930, back in the Great Depression. An ounce of gold gets you a nice suit today. An ounce of gold got you a tunic, belt, and sandals back in Rome. So an ounce of gold equals an ounce of gold. When you look at the gold price, you're not really looking at the value of an ounce of gold changing. What you're looking at is the dollar changing, the credit market changing, the money supply changing. And the banks like to psyop you by saying, oh, gold's volatile. Stay away from gold. It's so volatile. But the reality is gold's the most stable asset class on the planet. And it's the credit that's volatile. It's the currency that's volatile. So pretty crazy stuff, you guys. For altcoins, for crypto, I think Bitcoin's doing great because it doesn't carry any counterparty risk similar to gold. There's nobody on the other side of that transaction. It's just like a speculative token with no counterparty risk. And the world really likes that right now. They don't like counterparties. They don't like trying to do business with each other. We got trust issues inside the country, outside the country, a lot of uncertainty. So Bitcoin's holding up really well. not having any counterparty risk, arguably the only cryptocurrency that works and is truly decentralized. We have gold holding up really well, no counterparty risk. Gold represents the work that is already done and stored. Same with Bitcoin. So markets kind of represent work that is going to be done. It's promises to do work. It's promises to do productive jumping jacks for you so that I can spin off part of my profits to you in the form of like some kind of dividend or yield. Gold is like the antithesis of that. Gold is work that is already done and stored, as opposed to work that is promised to be done later. So nobody likes work that is promised to be done later right now, and everybody's likes the unit of account, likes work that is already done and stored. And that's why gold and Bitcoin are doing well. The stocks aren't doing well, and altcoins aren't doing well, because altcoins do have counterparty. It's whoever those devs are, those developers on the other side of that coin, you know. What are they trying to do, right? Build an application, sell NFTs, do something with AI, you know. Those altcoins, they're not really like cryptocurrencies. They're more akin to unregistered speculative tech stocks. That's kind of what they're more comparable to. And as you look like tech stocks, those things are bleeding everywhere. And so, you know, glove fits, so are the alts. But pretty crazy, you guys. But I'm buying the dips in altcoins. I ain't afraid. I still love memes. I still love Pepe and Retardio. And, you know, I have fun with it, you guys. So in closing, you know, looking forward, I would say we're looking at 4 interest rate cuts, not 2. That should be good for our bags. We're looking at an emergency meeting. Hopefully, that should be good for our bags. We're looking for Trump to roll back some of these tariffs. Hopefully, that should be good for our bags. We're looking for a relief rally in altcoins. That would be great to see. A relief rally across the board would be great to see. I think inflation is going to remain a sticky problem, has for the last, you know, half decade. That tends to be a decade ordeal, you know, so it's not a 2-3 year apparition. We've been saying that for years now, and it's been true. We've had this sticky inflation sticking around kind of thing. So yeah, I'm hoping for a relief rally across the board. I'm hoping for interest rate cuts. I'm hoping for risk appetite to actually increase. And, you know, all this risk off has been wild, guys. All this money leaving the stock market the last few days and flowing into the bond market, it's been pretty wild. So, woof. Sticky inflation, recovery for risk assets. That's kind of what I see happening. Hopefully. On the other side of that, let's say there is no emergency meeting over the weekend. Trump keeps doubling down. Other countries keep retaliating. Fed can't come to the table with Trump. Commercials and banks and the Treasury are nowhere to be found. It could get nastier. Maybe it'd be a good time to consider increasing your exposure to international stocks or emerging market ETFs. Start looking outside of the country potentially as the BRICS alliance continues to grow. Brazil, Russia, India, China, Saudi Arabia, South Africa, and as that dollar empire continues to kind of like buckle, like, I don't know what's going on. Because the reality is, if you're holding U.S. Treasuries and you're from Indonesia and I'm holding U.S. Treasuries and I'm from New Zealand, we're both talking on the phone right now about how to get exposure to something other than U.S. Treasuries, U.S. dollars. Maybe we're looking at new trade deals between one another. Maybe we're looking at gold as a good alternative to dollars, Bitcoin. You kind of get the idea. And let's say I'm Indonesia and I have a bunch of U.S. I'm just throwing out country names, you guys, as an example. But let's say I'm Colombia and I'm sitting on a bunch of U.S. Treasuries right now. Could be looking to reduce exposure to those. I'm going to sell them. Maybe they end up going to India first, and then they get sold there, and then they end up in China, and then China dumps them. My point is they're going to move around until they slowly find their way back to the United States. And if we lose the world reserve currency status, that's like bad inflation, guys. That's like hyperinflation, because all that inflation that you've been exporting to the rest of the world, they don't want anymore, comes washing back up on your shores. Hyperinflation, you know. So I see debts and deficits continue to explode. I see the dollar continue to be weak, and I'm hoping we can reinflate these risk assets all the way out to the end of the risk curve. Guys, I could really use a bailout for my meme coins. So that's it. That's what's going on with me. kind of the framework I'm working with. I hope this gives you something to work with. Thanks for hanging out with me. We'll reconvene as things progress. Okay, I know it's been a while since my last video. I apologize for that. I'll be coming out a lot more often to kind of guide you through this recovery or not, right? So we're gonna be coming back out here, talking it out, building a framework, trying to stay out ahead of things, trying to anticipate instead of react. And that's just kind of the mode we're gonna be operating in. So let me know what you guys think in the comments. Thanks for hanging out with me. Like, subscribe, comment, share, whatever. You guys are awesome. And we're just gonna keep going, all right? Till next time.